Hello, ladies and gentlemen. My name is Bart DiLiddo, and I'm delighted to be here today. We're going to be talking about my favorite subjects, stock valuation and stock market cycles. I enjoy giving this talk because these topics are always of current interest. What we will learn today is how the market works, how to value stocks, and when and why bull and bear markets begin and end. So let's start with the efficient market theory. This theory states that all market participants receive and act on all relevant information as soon as it becomes available. This is a very controversial theory because the purists believe that if all market participants receive and act on all relevant information as soon as it becomes available, no single investor has an advantage over any other investor. In fact, many of the supporters of this theory believe that it's impossible to beat the market. In other words, you cannot outperform the market over a long period of time. The reality is, however, that all market participants do not receive and act on all relevant information as soon as it becomes available. I, for one, have believed for years I'm among the last to ever receive information. However, there is a tremendous demand to receive information as soon as it becomes available. For example, some large investment groups were paying extra money to Thomson Reuters to receive the University of Michigan Consumer Confidence Survey about 30 to 40 seconds ahead of everybody else, so they could act on it before it became general information. They were paying up to $1 million a month, I believe, for that information. So the relevant information is in very high demand, and people want it as soon as they can get it. Relevant information is any news that causes a change in the perceived value of a stock or stocks. And it could be good news or bad news. Stock prices rise when the perceived value increases, and stock prices fall when the perceived value decreases. Now, this good news could be something regarding the economy, could be something regarding the earnings prospects of a new company. It could be something that regards a new product or discovery that a company might be made. It could also be something regarding the economy or the weather. For example, there was a tsunami in Japan in 2011 that destroyed an atomic energy plant and caused the market to fall very sharply and literally gutted the use of nuclear technology in several countries over the last 3-4 years. So there is good news and bad news. And the media keeps pounding away at us day after day, month after month, year after year, with a flow of valid news, of hype, and speculation. So how do we cut through all this information and make sense of it? What we have to do is think in terms of the news and its financial consequences. There are financial consequences for companies themselves, or there are consequences that affect the economy. So when we organize our thoughts along this direction, we can see the following. History tells us that all relevant information is manifested by changes in earnings, inflation, and interest rates. Ultimately, everything ends up resulting in affecting one of these three things. And these are the three key factors affecting the value of stocks. Let's take a look at some data. Here I show a chart of the S&P 500 price over the last 10 years versus, at the lower portion of the graph, versus the earnings per share. And we can see that prices go up as earnings go up, and prices go down as earnings go down, and then they go up again. The correlation is very high, well over 90%. So we can conclude that stock value goes up when earnings rise. The next piece of information we want to look at is the comparison of inflation versus PE ratio. Here in this slide, we have S&P 500 PE ratio versus the CPI, the Consumer Price Index, from 1960 to June 2014. And in the blue, we have the S&P 500 PE ratio, and in the red, we have the CPI percentage change, which is shown on the right-hand portion of this graphic. So we can see that when inflation goes up, the PE ratios go down. And the PE ratios are going down because prices are going down. And then as inflation comes down, the PE ratios go up. Here again, we have this situation here where the PE ratios were coming down, inflation began to go up, and then we ran into the 2008 financial crisis, and the data became very erratic. So what we can conclude is that stock value goes up with falling inflation. The next graphic shows a correlation of S&P 500 earnings yield, and earnings yield is defined as 100 times earnings divided by price. Earnings divided by price, of course, is the reciprocal of the PE ratio, and what we're looking at is the percent earnings as a function of price. This earnings yield is literally the kissing cousin of dividend yields. Everybody understands what a dividend yield is. It's the dividend divided by the price times 100. Well, what we're looking at here is the earnings divided by price times 100. So it's not a very difficult concept to accept. Now, that's versus the 30-year T-bond interest yield. Here in blue, we have the earnings yield, and here in red, we have the interest yield. And notice how they both go up and down together. Many analysts say this comparison is equivalent to a tango. When one goes up, the other goes up. When one goes down, the other goes down. And here we got graphics going all the way back to 1960. It's a very strong correlation. Now, when earnings yield goes up, that means prices are going down. So we could say stock prices go down when interest yields go up. Stock prices go up because the earnings yield is going down when the interest yields come down. Okay? And so we can conclude that stock value goes up with falling interest rates. In summary, stock value goes up when earnings go up, inflation goes down, and interest rates go down. Given that model, how do investors decide where to put their money? They can either buy stocks or they can buy bonds. Let's look at the next relationship. Money goes where money grows. In other words, investors will always put their money where they think they are going to get the greatest rate of return. Now, investors will buy stocks when EY is high and stock prices are low. When they buy stocks, they're looking for a capital appreciation and they are being greedy. Investors will buy bonds when they want to preserve their capital and there is fear in the market. You've heard the phrase, the flight to safety. That's when investors take their money out of the stock market and put it in bond market. This relationship, EY versus IY, is among the most important that you should see in the financial markets. This is where the battleground is taking place every day in the financial markets. It's the major decision that investors make. I have here the ratio of S&P 500 earnings yield and the 30-year bond interest yield from 1960 to 2014. When this ratio, EY divided by IY, is above 1, that's an indication that investors are being fearful. In other words, stock prices are low and bond prices are high. Investors are taking their money out of stocks and putting it into bonds. And you can see for the period of 1960 into about 1968-69, fear was dominating the investment scene. And there were several years where investors were favoring stocks more than they were bonds. However, in 1973, there was the Arab oil embargo, and there was a recession in the 73, 74, 75 period, and investors began to avoid stocks again. And this went on all the way into the early 80s. And for a long period of time, from the early 80s all the way into the year 2000, investors were favoring stocks. In 1982, Alan Greenspan lowered interest rates. It was in August 1982. He lowered interest rates and stock prices exploded. And this great bull market lasted year after year after year. It finally ended in 2000, and then fear took over again. We had a short period of time in the late 2000s where investors began to favor stocks again because of extremely low interest rates, and that led to the financial bubble that occurred in 2008 and early 2009. And this is where we're at today. There is a tremendous disruption in the normal marketplace proceedings because of the interaction of the Federal Reserve buying bonds and lowering interest rates to a high degree. One of the things we have to consider is that ideally EY should equal IY. In other words, there should be an equal desire to buy stocks versus buying bonds. But in reality, investors know that stocks are more risky than bonds, and so they demand what is called a yield premium. In other words, in order to buy stocks, investors want to have an extra yield that they see. For example, if the earnings yield is 5% and the interest yield is 5%, the investors will not buy the stock. They will favor the bond because it's a safer investment. And so they would want what's called a yield premium. They may want 6 or 7% total. In other words, the yield premium would be 2% or 3%. So the yield premium becomes a very important factor in making this decision on where to put your money. We can use this relationship, however, to value stocks. If EY were equal to IY plus YP, we can substitute for EY. We have 100 times the earnings divided by price. That's a little formula we saw earlier. And that would equal the interest yield plus the yield premium. Now, if we substitute value for price, we get this relationship. And solving for value, we would say the value is equal 100 times earnings divided by IY plus YP. In other words, earnings divided by the interest yield and the yield premium. And what this says is that if, for example, the earnings were $1 a share and IY plus YP equaled 5%, we'd say that 100 divided by 5 would be worth $20 a share. This is a very simple formula. You can do it in your head. Let's take a look and see how it works for McDonald's. As of July 18, 2014, we have McDonald's has a forecasted earnings per share of $6.10. The current interest yield plus yield premium, which I obtained from the S&P 500. This is the average interest yield plus yield premium for all 500 stocks in the S&P 500. So if we do the math, we come up with a value for McDonald's of $108.93 per share. The closing price for McDonald's as of July 18th was $104.38 per share, which is very close. Now, this formula does not include the important factors of earnings growth, earnings profitability, interest rate, includes interest or inflation rates. Let's take a look at a formula that brings in these factors. This formula says that value is equal to 100 times EY divided by IY plus YP. Now, that's the formula that we saw on a previous slide. We take that formula then, and we multiply it times the square root of R, which is the profitability factor in percent, G, which is the earnings growth rate, and we divide these two together. R is a profitability factor based on the return on total capital. And that's the money you get back on the money you invested in the company. If the return on total capital is high, you would expect the value of the stock to be more. If the rate of return is low, you would expect the value of the stock to be lower. Think for a minute you have two companies. They each have $100,000 invested in the business. One company makes 10% of their money. The other company makes 20% on the money. So at the end of the year, the company that made 20% has more money that they could use to grow the company. So R, as a matter of fact, represents the internal growth rate of the company. The ability of the company to grow without going into debt depends on their profitability. If the company had no profitability, that was zero, they would have no money to put into research and development or new sales or develop products. So R is a very important factor in calculating the value of the stock. G, that's the earnings growth rate that you see reported for the company. Okay? The profitability factor, return on total capital, is given in the financial reports based on the balance sheet and things of that sort. So these important factors, earnings per share, the interest rate, profitability, earnings growth rate, and inflation rate, are all in this formula. This last term, this is interest yield plus yield premium. We have it up here. And F stands for inflation. What this term says here is that the profitability plus the growth rate divided by 2, the average growth rate of the company should exceed the sum of the interest yield, yield premium, and inflation for the company to actually be growing at a rate faster than inflation and interest rates. And that's very important in analyzing a stock and understanding how to select more favorable stocks. Let's see how this works for McDonald's. The data is from July 18, 2014. What we have here is 100 times E divided by IY plus YP. And this is the formula that we worked out earlier. So that's $108.93 per share. Now, the profitability factor for McDonald's, which is based on a return on total capital, is 10.2. And actually, that's a pretty good number. The growth rate of McDonald's at this point in time is 2.0. 30, 40 years ago, McDonald's was a very fine growth company. Over the last few years, it's having a more and more difficult time growing. So this is a forecasted growth rate computed by VectorVest, and it's a relatively low number, 2.0. Now we take 10.2 and 2 and add those together and divide by 2. As we indicated earlier, interest yield plus yield premium is 5.6, and I'll show you in a minute where I got that number, and the inflation rate currently is 2.1. So we take 108.93 times the square root of 0.79, and we get a value of $96.89 per share. As I indicated earlier, VectorVest had identified the value of the stock at $104.38, and using a slightly more elaborate formula than we have here. This is the only formula that I'm aware of that includes all the factors of earnings, earnings growth rate, return on total capital, interest, and inflation rates. Most of the time, folks are strictly looking at the earnings versus the growth rate and things like that. But this is a very complete formula, and we've had very good success with this formula over the years. What we have here is a slide we call Doing the Dow with VectorVest. It started in 1970 to June 2014. I actually started performing this calculation in 1978, and I went back all the way back. I took the data and went back all the way to 1970, and I calculated the value of the 30 stocks in the Dow Jones Industrial Average all the way back to 1970. And so you can see this correlation. Of course, it looks very, very close. The most interesting thing that I saw with this was in 1987. And in May of 1987, I got a calculation for the Dow that was less than 2,000. Okay? And 87 was a good year for the market, and forecasters were indicating that the Dow was going to go above 2,700. And we were getting numbers down slightly below 2,000. You can see that difference right there. Now, you may recall in October of 1987, October 19th to be exact, the Dow Jones Industrial Average fell over 500 points, and that was called Black Monday. I'm not saying that this calculation predicted it, but it certainly indicated that the market was becoming overvalued. And you can see how the red line and the blue line cross over and over again. And this leads me to believe that sooner or later value will always come to meet the prices. Here, this is a 1999, and there was a strong bull market in the 90s, and in March of 2000, the market peaked, and at the same time, the value of the stocks in the Dow were well below the price of the stocks in the Dow. And so in March, the market peaked, and we had this bear market through 2000, 2001, and 2000. And in 2003, the market bottomed, and interest rates went very low, and earnings started going up, and the market exploded. In the period of this period here, I wrote an essay called The VectorVest Rocket, and prices and value did rocket. And things were going along fine until we got into the 2006, 2007 period, and we had the financial crisis, and you can see how both the valuation and the market crashed. And finally, in March of 2009, the market started to recover. You had a bull market again. I could spend a half a day talking about this graphic and relating it to what was going on in the country and in the stock market. But this graphic tells a story of itself. So stock valuation is a very important consideration. And VectorVest has the wherewithal to calculate stock value and to use it to improve your investment results. Now, the current situation on stock valuation is that the Dow Jones Industrial Average is fairly valued. As of July 18th, the actual Dow closed at 17,100. The VectorVest estimate of the Dow Jones Industrial Average value is 18,174. These numbers are within 6.3% of each other. And our belief is that if the DJIA and the VectorVest investment average are within 10% and the DJIA is less than the VectorVest estimate, that means the Dow is fairly valued. Now, if it were the reverse situation, if the actual Dow was above the VectorVest estimate, we would say the Dow is fully valued. And we publish this information day after day. Jerry, can we go into the VectorVest 7? Jerry, first of all, I'd like to have you click on Viewers and click on the S&P 500 watch list. And is that the S&P 500? Yeah, you're only showing 5. Let's find this number right here. The earnings per share. What's that earnings yield? This is as of what date? The 20th. Go back to the 18th. The earnings yield is 5.6%, and that represents the average earnings yield of all 500 stocks in the S&P 500. And that's what we used. And what we're saying is investors are willing to use that factor in deciding whether they want to buy bonds or put their money in stocks. Okay? Jerry, can you do a find here? Find MCD. There's McDonald's, and this is still on the 18th. Okay? And here's the growth rate, which is 2% a year. And here is the earnings per share that we used in our formulation of 6.1%. Now, as far as the value goes, here's a 104.38 that we also cited as our comparison. So this data is right in the database. The next thing I'd like to have you take a look at, Jerry, is the views. And let's go back to the 18th. Each and every week, at the end of each trading week, we write a newsletter called the VectorVest Views. And Jerry, go to the drop down, click on the overview, that's fine. And let's scroll down a bit. And we have a section in the views that we call Valuation. There it is. And we say here, in a volatile week of trading, the mighty Dow rose to the challenge of geopolitical concerns and a hawkish Fed governors to gain 156 points to close the week at 17,100, which is the number we cited. Our trustworthy VectorVest DJIA rose 15 points to 18,174. It is now 6.3% above the mighty Dow, and is saying that the Dow is fairly valued. The price of the VectorVest composite, which is an arithmetic average index of all the stocks in our database, fell 0.03 of a cent per share for the week ending, and the value of the VVC fell 8 cents. The value of the VVC is now 4.8% below the price of the VVC. And that we would say that the value of the VVC is fully valued. And so we not only give you the valuation for the stocks in the Dow, but we give you a value for every stock in the database. And each and every Friday, we give you this comparison, and the data is shown here. Okay? Let's now talk about what causes bull and bear markets. Bull markets are born when the economy is weak, inflation and interest rates are low, and earnings are expected to rise. The last time this situation prevailed was in March of 2003. All of us are over 11 years old here in this room, so you probably remember this period. It was a period right after the financial meltdown, and things looked awful. The economy was weak, inflation and interest rates were extremely low, but earnings were expected to rise. And how do we know that earnings were expected to rise? Is because Citibank on March the 10th of 2009 reported that they made a profit in the first quarter. Well, this is after earnings had collapsed in 2008. So that was good news. And the bull market that we are currently experiencing in 2014 started on March the 10th, 2009. Bear markets begin when the economy is strong, inflation and interest rates are high, and earnings are expected to fall. Just the opposite situation. The last time this situation occurred was in November of 2007. The market had bottomed and a bull market started in 2003, and the market went higher and higher and higher year after year after year. But in 2007, the economy was cooking along very well, and the Federal Reserve started raising interest rates, and so the economy was strong, and they were raising interest rates because inflation was going up. However, the data we keep indicated that earnings were starting to slow down. And this is a key factor. Earnings were expected to fall. Okay? And Jerry, let's go back into VectorVest and go back to November 2nd of 2007. And let's go to the strategy section. Here in the strategy section, we indicated that the price of the VectorVest composite fell for the second consecutive week yesterday, Thursday over Thursday, and the buy-sell ratio fell below 1, thereby signaling a confirmed downtrend. Moreover, it continues to appear that the price of the VVC is completing a double top formation, which suggests that the stock prices have further to fall. Once again, we should note that the infamous July high struck on July 13, which is not exceeded by the August 18th. Okay. Also notice that the trend from the August 16th low through October 19th low has been broken. It appears that my worst fears cited in October 19th have come true with a down situation. And go to the views, Jerry. And go to the bottom. I wrote a special note, a word to new subscribers. The confirmed down signal that we received yesterday could be the entree to a long bear market. We aren't there yet because earnings are still rising according to the method of analysis. Yet we no longer appear to have the support of accommodating Fed, and that can make things very bad for the stock market. So don't be deceived by the endless parade of experts who will appear on TV and other places telling you to buy stocks. This is not the time to buy stocks. And this was the first serious warning to our customers in years that it was not a time to buy stocks. Okay? And how did we see this coming? I will show you evidence of how we got here in a few minutes. Okay? And Jerry, go to the views on March the 6th of 2009. Stay in the essay part. Here, I wrote a essay calling Itching to Rally. Everything we do in VectorVest is documented. You can go back and read it and see it. And let's get to the bottom line here, Jerry. The bottom line is that this market is itching to rally. And so we gave guidance in the strategy section to our subscribers that if they see an explosive up move in stocks, it was time to buy stocks. There, right there, Jerry. For those of you who are writing, we are playing the downside of the market with contra ETFs. We will exit these positions that go along with one of the following strategies if an explosive rally occurs. And we listed 6 strategies. We actually got into a strategy called jailbreak no contra ETFs, and this happened on the morning of March the 10th. So we were four days early, 2 trading days early, and these stocks from this strategy were up 17% in the first 30 minutes, 35% at the end of one day. And that's usually more profit than people make in a year on the average. And so this was a very good call, and VectorVest nailed the top and we nailed the bottom. Okay? Now let's talk about how we do these things. All right. How the market works, the virtuous vicious cycle. What we want to do in analyzing where the market is heading, we want to look at inflation very carefully because inflation drives interest rates. Right now, inflation is said to be very low, but inflation is a very controversial subject. Most people think inflation means that the price of goods and services is rising. Others believe that inflation is driven by money supply. And we all know that the Federal Reserve has been printing money by the billions of dollars, trillions as a matter of fact. And so the feeling is that there will be a major inflationary cycle taking place in the near future. But right now, the Federal Reserve is worried about deflation. And so they continue to print a lot of money. So the thing we want to watch very carefully are inflation rates because they drive interest rates. Interest rates dictate the strength of the economy. I like to think of interest rates as a thermostat in your room. If the room is cold, you raise the set point on a thermostat and the heat comes on. And so what the Fed is doing, they feel, well, the economy is cold, so they're printing money, which is supposed to heat up the economy. And if the room becomes too high, you lower the thermostat and the air conditioner comes on. So when they feel like in November 2007 that the economy was too hot, they raised interest rates and that caused the economy to cool down. And usually they don't have that good a control over it. And so we have this cycle of bull markets and bear markets. In 2009, after the bear market took place, they lowered interest rates to very low rates. In fact, the short-term interest rates is essentially zero, and the long-term rates are the lowest in 50 years. So these two factors, the bull and bear market cycles begins with inflation. It depends on where inflation is going. Now, interest rates dictate the strength of the economy. The economy affects earnings. Earnings ultimately cause stock prices to rise and fall. And we saw that in the graph with the S&P 500 versus the earnings per share. It goes up when earnings go up and goes down when earnings go down. And so all of this is tied together. And these are the 3 things you need to watch very carefully. Inflation rates, interest rates, and earnings. And we do this in VectorVest, and we report on it every week. We have a report in the views that we looked at earlier where we monitor earnings, inflation, and interest rates. We also monitor market direction and investor sentiment. And what we do is we look at this information in what we call the truth chart. Now the truth chart identifies 8 scenarios. E stands for earnings, F stands for inflation, I stands for interest rates, and P is prices. And what this says is that if earnings are going up and inflation is going up and interest rates are going down, prices will rise. And this is a situation where bull markets begin. And you see bull markets begin after the bear market ends. So in the bear market, earnings were going down, inflation was going up, interest rates were still going down, and prices were still going down. This is basically the situation we were in early March. And what investors look for is the first hint of the ability to increase prices. That's the first thing. And that is identified by this U here. In other words, the first indication of pricing strength is an indication that the bear market is going to end. So we end up here, so we go here. And if prices start going up, earnings would go up, inflation would go up. The Fed is still lowering interest rates, but the prices will start going up. And so we have these various scenarios. Scenario 2, you can see here. Earnings going up, inflation and interest rates go down. This is called the Goldilocks situation. You remember from the formula that we had, we saw that when earnings are going up, value goes up. When inflation and interest rates go down, value goes up. So this is the best of all worlds. A case 2 scenario, a bull market thrives, and that is often called the Goldilocks scenario, where earnings are going up and inflation and interest rates are going down, but not too fast, and prices are going up pretty fast. Now, this situation where everything is going up, earnings, inflation, interest rates, case 4, and prices are going up, this is when the bull market ends, and this is where we were in November 2007. Okay? And notice this, that in the truth chart, when earnings are going up, all these scenarios are bullish. When earnings are going down, all these scenarios are bearish. So what we do is we watch the relationship of earnings. We calculate forecasted earnings. We buy that information from Thomson Reuters, and we extend it. We analyze it ourselves, and in the market climate section, we give you an analysis of where we are as far as these scenarios. Right now, the current situation, the U.S. market is in a case 4 bull market scenario. Earnings, inflation, and interest rates are rising, and that's of July 17, 2014. We report this information each and every week, and we state it. Now, what we also do is we have a graphic of this information of the relationship between forecasted earnings and the earnings trend. Right now, the earnings are still trending higher. And what we'll do, we will watch that earnings trend very carefully and report on it in this fashion, because when we see that earnings trend going down, and if it ever starts heading down, we're going to go back and start warning our subscribers to be aware that a bear market situation exists. And that is the time to be very careful with your investments. Now, the outlook is the bull market will continue as long as it is perceived that earnings are rising. There's a lot of talk going on this summer of 2014 that the market is overvalued, and I read stuff about a major collapse taking place and all that stuff. And my belief is, my firm belief, that as long as earnings are going higher, we will be in a bull market situation